Hello, this is Eric Parnell, Chief Market Strategist from Great Valley Advisor Group, and it's finally happened, the long overdue stock market correction. Now, why do I say the stock market correction is overdue? Well, one of the ways that we can tell whether a market is running too far to the upside or too far to the downside is its difference between its moving averages. Now, on the chart that you see in front of you, there's three different lines in addition to the market. There's the stock market line itself, which is the black and red line. There's a blue line, which is the 50-day moving average, a red line, which is the 200-day moving average, and a pink line, which is the 400-day moving average. One of the things that we saw with the stock market coming into 2024 is that not only was it above its moving average lines, but the space between the moving average lines were widening. The more the market moves in one direction and those spaces between those lines widen, the more the market is too far extended one way or the other and overdue to what's known as revert to the mean. We were overextended at the beginning of the year, but as we all know, the first quarter of 2024 was a fantastic run for the US stock market, gaining another 10% plus in the first quarter. But no sooner did the calendar pages turn to the second quarter in the beginning of April, and the correction got underway. So where have we come to so far? We've seen a 5% correction on the S&P 500 through the middle of April, with the stock market falling in 10 out of 14 trading days. Now, one of the things that's been notable is that the market's been up on many of those days, only to end to the downside. This is a sign of a stock market that wants to consolidate. It wants to mean revert. But that mean reversion process takes time. So as we look at the correction that's taken place so far, one of the things that we should expect is that this correction's probably got a few more weeks to run. When we take a look back in history and when the market goes through these consolidation phases, typically the market falls anywhere between 5 to 12% over a 4 to 8 week period. We may see some bounces along the way, but it's likely the market has more froth that it needs to work off before it finds a new bottom. Now, the good news is that this is normal market behavior. The fundamentals remain strong. We have good economic growth. Corporate earnings are growing at a double-digit clip. Inflation continues to come down. And even if it's flattening out, that's still a positive thing. So the fundamentals are good. This is good, normal market behavior, the types of pullbacks that help shake out some of the weak hands, helps cleanse some of the misallocation of capital, and sets a new foundation for the market's next move higher. Thanks for joining me for this latest Market Insight, and I look forward to seeing you again soon.